audit committee's internal audit and your AA exam. Firstly, don't confuse, don't get mixed up between internal audit and audit committees. Audit committee is made of INEDs, independent, non-executive directors. At least 3 of them, at least 1, should have recent relevant financial experience, while internal audit could be employees of the company, or it could be outsourced to an external firm. Also, the role of audit committees, well, what they do is they act as a buffer. They are the main point of communication between management and the auditors. That's external and internal auditors. They oversee the main processes in the company that management are involved with. That is the risk assessment, the controls, internal controls, and financial reporting. They don't do that. They oversee these things. They also review the need for internal audit and whether it should be outsourced or in-house. They could research what external audit firm should be appointed to advise the board on that, so the board can present that firm to shareholders for appointment. That's audit committee. They're the main things, if you wish, that audit committees do. Now, how can internal audit be examined in AA? We might be asked to compare and contrast internal and external audit, or we might also have to talk about benefits or advantages or disadvantages of outsourcing internal audit. So if we have to compare and contrast IA and external audit, now think about how they both have to audit. So they both do checking and provide assurance, but the difference is that external auditors check the financial statements, whether they're true and fair, and they provide assurance to the shareholders who are external to the company, while internal auditors can check anything that management want in broad terms, and they report to management who are internal to the company. That's why internal audit is called internal, and that's why external audit is called external. So that's one thing. Another thing is that external auditors should always be independent, while internal auditors could be independent if they're outsourced most often, but they may be also company's employees. Another difference, external audit is compulsory, that's why it's called statutory, while internal audit is optional. Even for listed companies, they don't have to have internal auditors, but they have to consider every year whether they need IA or not. And now if we have a question on advantages or disadvantages of, say, outsourcing IA, of course it has to be scenario specific, but the main idea is to consider advantages. If you outsource, means that you don't have to pay salaries, so if you don't need IA too much, then you could be saving because you would only pay the fee as and when you need them. Second thing is you get quick access to the expertise, to that experienced team that would be sent to you. And third thing is those IA, internal auditors, would be independent because they are not employees of the company. However, the disadvantages of that are that if you start using them too much, the fee could become a little bit too expensive, and you have a little less control over the team because they're not the company's employees. So you as management will have to deal quite likely with different people as well, different times that are sent to you. And if you had an IA department, small one, that you let go, then you would have the further cost of potential redundancies and you would be losing in-house skill.